Hello and welcome. Today we are going to focus on companies. Now, what is a company? A company is defined as per Companies Act number 71 of 2008. The CIPC, which is the Companies and Intellectual Property Commission, is the registrar for companies. In order for an entity to be classified as a company, it has to be incorporated by means of a memorandum of incorporation. Now, what is a memorandum of incorporation? This MOI, or memorandum of incorporation, is a document that outlines the functions within the company itself, the director's duties, the laws that regulate the daily functions within the company. And by filing this in document called the MOI, the company now then acquires a separate legal personality. We say a company is now a separate legal entity. Now, what does this mean? This means that if and when a company or a company or a company directors face a grave legal consequences, then a company is to be blamed, or the person having an issue, a legal issue with the company, is to sue or have a case against the entity itself and not the shareholders or the directors. That's what we mean. I don't know if I can simplify it better, but separate legal entity means that if and when there's a legal issue, it has to be taken up with the company and not the shareholders and the directors themselves. Now we have several types of companies. We have a public company, we have a private company, a state-owned company, and a personal liability company. Now, the difference between these companies is the way the MOI, or the Memorandum of Incorporation, is constructed. For example, a public company has in its MOI stated that it cannot issue its shares to the public. It can issue its shares to the public, to the general public. For example, those are companies listed on the JSE, the Johannesburg Stock Exchange, where me and you can go up there, find a broker and buy shares. So now this is a public company. And then we have a private company. This one issues shares and then we have a private company. A private company reflects an opposite of a public company. Now, we said a public company issues its shares to a general public, meaning me and you can go up to JSE and buy those shares. But with a private company, we have what we call limited liability and non-issue of shares, meaning this company cannot issue shares. And also we have what we call PTY, Ltd. Hence why you will see Pty Ltd when you go up to buy at some retail store somewhere. If you look at the slip, you'll see this Pty Ltd, meaning proprietary limited. Now, what does this Pty Ltd entail? This entails that the company is incorporated, it's a company, number one. Number two, it does not issue shares to the general public. And number three, the ownership of this company is limited, hence proprietary limited, meaning there's a limit to the number of shareholders that can acquire the shares for this company. Now, moving on, we also have a state-owned company. So I would advise you not to dwell much on this because it's not examinable. A state-owned company is a company like Eskom, your Transnet, your post office, and all those companies that are owned by the government. The government has a major shareholding in these companies, and it can be a public company, it can be listed on the JSE. And now we have a personal liability company. Personal liability company is also a company, number one. And this company is designated for those who are professionals, those who require more complex regulations for their entities. People like doctors who start their own entities, lawyers, accountants, etc. These people require more regulations for their entities. So this is a personal liability company, meaning it's for professionals, professional undertakings. Now let's recap. We said the company registrar, the CIPC, is responsible for registering companies and making sure that companies comply with the Companies Act. The Companies Act number 71 of 2008. And then we went on to say a company is a separate legal entity, meaning a company has a separate legal personality. The owners cannot be sued or be taken to court for the company, but the court itself, of course, the representatives would be the directors or someone from the company. But if we need to sue, we are going to sue the company. The money is going to come from the bank account of the company and not of the directors. And now we also went on to say a company is registered, or we say it comes into effect by means of MOI, a memorandum of incorporation. For an entity to be called a company, it has to have a filing of a MOI. We must file with the CIPC by means of MOI, the memorandum of incorporation. And we also went on to talk about different types of companies: the public company, private company, state-owned company, personal liability company, and all others I didn't mention here. Yours is just to focus on these two, the private company and the public company. Know the difference between the two. Public company can be listed on the JSE, issues shares to the general public. Private company does not issue shares, and it has a Pty Ltd, meaning the shareholding is limited. Now, moving along, we are going to touch on IFRS and GAAP, GAAP. Some of you may call it GAAP principles. And what are these IFRS and GAAP. What is this IFRS and GAAP? Now, IFRS provides rules and principles to guide the preparation and presentation of financial statements, meaning this it's like a law. It's like a law. It's like a law, and this is a global law for accounting. That's why we call it IFRS, meaning international. Financial reporting standards. International financial reporting standards. Please don't mind my handwriting there. So these international financial reporting standards are used all over the world to compile. These are the principles that are used to guide the preparation and presentation of financial statements. In order for you to know how to classify assets, you must refer to this IFRS, this document called the IFRS. You can call it the IFRSs, and they are developed by the International Accounting Standards Board, IASB. So the IASB issues these rules, this document called the International Financial Reporting Standards. The board develops these standards, and as I have emphasized, these are international, meaning they are used all over the world. I hope we are clear on that one. And now we move on to GAAP. Now, what is this GAAP? As I've said, that IFRS provides rules and principles to guide the preparation and presentation of financial statements. Now, what are these rules and principles? Now, we are going to say these rules and principles are what we call GAAP. It's not all of them, but some of them are GAAP principles. These rules and principles, this is what we call GAAP, GAAP principles, GAAP. Now, what are some of these principles? The most common one and the most important concept under GAAP concept or principles, we have the business entity rule or the business entity concept, which states that the financial affairs of the company must be kept separate from that of the shareholders. Now, this is important. No matter the type of entity you have or you are running, you must keep the finances of the company separate from that of the shareholders. Let me highlight this with a different color. The finances of the company must be kept separate from that of the shareholders. Even if you are running a one-man show, I mean that type of entity where you are the sole trader. We call you a sole trader. Even when you are a sole trader, you should bear in mind that the business entity rule applies. The business entity concept is always applicable. You must keep separate financial records for you as a person and for the company or for the entity, separate. Then now we go to the second one, which is the going concern. I'm sure you are familiar with this concept. Going concern now goes on to say financial statements are prepared with the understanding that the company will continue in the foreseeable future. Financial statements are prepared with the understanding that the company will continue to operate. When we prepare our statement of our balance sheet statement, our profit or loss statement, which is the income statement, another word for income statement. When we prepare our statement of cash flows, we must prepare it in such a way that we are telling the shareholders, or we are telling a prospective shareholder, that this business is going to operate within the next 12 months. The business is still going to be operating. We are still going to receive cash. We are still going to be in a liquid position, in a solvent position. We are going to be able to pay our short-term debts and our long-term debts. We are going to be profitable. All this is around the concept of going concern. It's a going concern. Our entity is a going concern. Our company is a going concern. And then we have the historical cost concept. Now, the historical cost concept states that all assets are recorded at their original cost price. Example, our land and buildings are recorded at the price we paid for them. All assets, meaning when you show your assets on the balance sheet statement, you must record at their original cost price. You must show the cost price. If you bought a vehicle at the cost of 150,000, on the statement or on the note number 3, the note 2, finding to assets, the asset note, you must show the original cost price that you bought this vehicle at 150,000, despite the fact that it has depreciated and has a new value, which is the carrying value. Now we go to another concept called the matching principle or the matching rule, which states that income and expenses must be recorded in the correct financial year, e.g. sales and cost of sales. Now this is a very, very important principle, because now we are going to introduce a concept called accrual accounting. I'm sure you've heard of something called accrual accounting. Well, if you don't know what accrual accounting is, I'm just going to touch on it a little bit. Now, accrual accounting states that even when, or even if you let's say you purchase stationery. Now you purchase stationery for 5,000. When you purchase stationery for 5,000 rands, and then you get an information that tells you, now I'm going to do this in form of an adjustment. They tell you that this stationery has been paid, let's say 50,000 of this amount has been paid, and then the remaining 50,000 should be paid or will be paid in the next financial period. Now this tells us that 50%, which is 2,500, will be paid this year. As you may well know, that income is only the amount that we have for this year, or an expense, it's only the amount that we have for this year. If we go beyond this financial period or this year, then we are no longer taking that as income or an expense. So 50,000 for this year will be recorded as a stationary expense. That's how we are going to say we are matching this amount. 2,500 is going to be classified as a stationary expense, and the remaining that will be paid next year is going to be classified as an accrued expense. This is what we call accrual accounting, meaning the remaining amount is going to accrue. Now we say it's an accrued expense. That's what we mean by the matching principle or the matching rule. But don't worry, we'll dwell much on this when we go on with the next lessons. Now we go on to another concept, which is materiality. Materiality principle says that all important items must be shown separately in the financial statements. Example, the director's fees, or when decisions must be made. It is worth having separate accounts for wages and salaries if you have only 2 employees. Now, to simplify this, I'm going to give you an example of accounts that appear on the balance sheet statement. Under the balance sheet statement, we have assets. Under assets, we have fixed or tangible assets, and then we have current assets. Now, materiality says that under let's say, for example, under fixed assets, important items must be shown separately in the financial statements. For example, you would have in your tangible assets your vehicles. It's an important item. It has its own classification. It has its own significant values to be taken care of. And then you would have again the land and buildings and the equipment. This is what we mean by saying important items must be shown separately in the financial statements. Vehicles, equipment, and then land and buildings. You don't just take the overall amount of the total cost or the overall assets and just put the value there combined. You can't take the value for vehicles, for land and buildings, and for equipment and aggregate it to or totally net it off or total it there to make it a one-line item called assets. It's an asset, but these are all assets, but they have a separate significance, if I may put it like that. So these are all important items. That's why you show it as a vehicle, equipment, land and buildings, and not as general assets. And you won't draw up your balance sheet statement and put assets and not say we have these types of assets, and under these types of assets we have this asset and this asset and this asset. And we are going to touch on this in the next coming lessons. Just make sure you subscribe to our YouTube channel, RichTube, and join our e-learning platform for more of these lessons. Now we also have the prudence concept. Now the prudence concept says to us that figures used in financial statements should be realistic, conservative, always record the worst scenario. The aim of this principle is to show reality as it is and not make things prettier than they are. Now this is straightforward, meaning that you must show a sense of accountability when you prepare your financial statements. The figures that you represent must be the correct figures. Don't just manipulate figures or take figures out of the blue and prepare the financial statements that won't show reliability, that won't be reliable to the users. For example, if there's an important event that happened in the business, let's say a director of a company, or the CEO for that matter, the CEO stole money. Let's say the CEO stole 150,000. In our financial statements, we must state that in the notes that because this information is material, we must highlight this information, put it as a figure. That is, this is not an expense. This is a note, side note, that the CEO stole money, the CEO was corrupt. This is what we mean by prudence. Use figures that are realistic. Record the worst case scenario. If you made a profit of 500,000, don't make it 1 million. Record 500,000. Thank you.